Welcome to our video on going concern. My name is Simon Brooker and I'm an audit partner and leader of BDO's London Audit Group, a group of over 1,000 partners and staff focused on delivering the highest quality audits for our clients. I've been an audit partner now for over 25 years and I've seen an awful lot of change in financial reporting over that time. However, in the last 12 to 18 months, I've probably seen more change than at any other point during my career to date. This change wasn't just as a result of the big three new accounting standards, which changed some fundamentals in financial reporting. And it's not just because of the impact of the COVID-19 pandemic and the uncertainty in the economy and the challenges that this through at all businesses. The change is due to the public scrutiny that we all face. Directors, both executive and non-executive, and their auditors are now under unprecedented public scrutiny. Both directors and auditors now make headlines, unwelcome headlines. Directors and auditors are a focus for reporting and commentary from the press, and journalists reporting on anything from remuneration, our position on social issues, trading results, funding needs, and going concern. That assessment of the viability of a business. It's going concern that we are focused on in this video. Going concern is the assessment that the board makes to cover a period of at least 12 months from the date of the approval of the financial statements. The conclusion reached impacts the basis of preparation of the financial statements and provides insights to investors and creditors as to whether a business is viable to invest in or to provide goods and services to for the foreseeable future. Going concern assessments are not simple to do. There are lots of individual moving parts. There are lots of judgments and estimates, some of which can be controlled by the business, but many which cannot. All estimates and judgments can change, and all can therefore lead to increased risk that the board's conclusions on going concern do not pan out as expected. As a non-executive director, getting close to going concern assessments and the judgments taken by management teams is critical to ensure the inherent risk around going concern assessment is reduced. Knowing what to ask, when to ask, understanding what is happening in the market, what lessons can be learned from other businesses, either in your sector or more broadly, helps inform the robustness of the challenge non-execs can bring to the assessment over going concern. Therefore, in this video, we will hear from our experts who will provide an insight from their different specialisms on some of these areas to help directors provide more focused challenge to management on their initial conclusions and assessments of going concern. We will hear from Peter Hemington, who will provide some economic insight, Steve Carr, who will provide some insight of areas of focus for businesses with debt on the balance sheet, and lastly from Michael Grime, who will run through some lessons learned from cases where business recovery advisors have been involved in going concern assessments and where things have not panned out quite as expected. Many thanks.
Hello, my name's Peter Hemington, and what I'm going to do today is talk briefly about the reasons that we have to be optimistic about the way in which the UK economy is likely to recover over the next year or so. And the first point is we have multiple vaccines and we have very good evidence that they work. And so there has to be a very strong working assumption that we will see a return to normal life in the UK during 2021. Perhaps back end loaded, but I think we can say with a high degree of certainty that it's going to happen. The second reason, I think, for being optimistic is that, by and large, although we can always criticise, The government response to the crisis has been very good in terms of its response to the economics. We've seen the furlough scheme, we've seen the tax deferrals, and we've seen various other measures to protect the businesses across the UK. And while there has been, one has to say, a fair degree of pain in the economy, the fact is that it would have been a lot worse without these particular schemes. And a very good indication of how successful they've been is the fact that corporate insolvencies in the UK, looking at the last available data, which is in the autumn of 2020, were down by more than 40% on the same period in the preceding year. So what you're seeing is lots of government spending kick in to protect not only jobs, but also to protect businesses. And by and large, those measures have been successful. Not that one isn't aware of the pain that individuals who have lost their jobs and businesses that have gone out of business have suffered. A third reason why I think we can be positive about the future is that the UK is, of all the large economies, the large developed economies, the one that has the largest consumer economy. It's about 2/3 of the economy by output. The UK consumer obviously has not been able to do the things that she and he would have liked to do because we've all been locked down. And as a result, there is an enormous degree of unspent dry powder. So the Bank of England recently estimated this at about £100 billion. Another way of looking at that is that the UK economy is probably about £2.2 trillion in size. So that's something like 5% of the UK economy, effectively sitting in people's bank accounts, unspent. And when we see a return towards normality, as more people have the vaccine, as hopefully lockdowns end, that money will be spent by and large, and we will see a big increase in consumer spending over quite a big period, which will really kickstart a recovery. It's worth saying in that context that the recoveries that we saw after lockdown one in most sectors were pretty linear and they were pretty quick. I see a lot of data from the restaurant industry, and it took, by and large, about 8 to 10 weeks before businesses were pretty much back to where they had been prior to the pandemic. Not all businesses, but that's what the overall figures tend to say. Finally, there has also been concerted action worldwide by central banks, which means that money is cheap and it is plentiful at the moment. And this means that the capital markets are pumped full of cash. Perhaps one illustration of that is the Bank of England's 550 billion of quantitative easing that it spent on asset purchases during 2020. And that's more than £100 billion more than the QE that took place after the crisis of 2008. So a very significant intervention in the financial markets by the government. And we've seen, particularly in the States, less so in the UK, but we've seen the impact of that is highly pumped up stock markets and lots of cash in the investment part of the economy that wants to invest in businesses if it can find a way to do it. So successful businesses and successful sectors have seen a real interest by investors in investing. And I think we'll see that spread to other sectors as we go through 2021. Now, I'm not pretending it's going to be all good news. The OBR, the government body that checks up what the government's doing in terms of its budgeting, they're forecasting unemployment of around about 7% at the peak towards the end of the year. But that compares with 8.5% after the global financial crisis of 2008. And in fact, they had a forecast that they put out in July 2020, the OBR, that said that the unemployment rate might be as high as 11% at the peak because of the pandemic. So it appears that things have got better. There will be bad news in sectors that are significantly impacted: hospitality and leisure, my sectors. Transport's another one, some aspects of construction. And of course, unfortunately, we've seen some real issues in the physical retail sector where the channel shift has brought forward, perhaps 5 or 10 years worth of change, crammed it all into 1 year. And of course, there have been some real problems there and some real dramatic restructuring has had to take place. So you may have to sift at times through the bad news to see the good news. But I believe that 2021 will see a strong economic recovery, which will continue into 2022. And we'll see real opportunities for individuals and businesses because of that recovery.
My name is Steve Carr, and I work in BDO Debt Advisory. We provide specialist independent advice to best help companies raise debt by optimizing the presentation of the credit story, evaluating the options available, identifying the best source of funds, extracting the most attractive terms from the market, and reducing execution risk and costs. In order to be considered a going concern, the audit must be able to obtain sufficient assurance that the business has available committed funding which is sufficient to cover working capital requirements and committed expenditure for a period of at least 12 months from the date of signing. Therefore, if the business is in default, meaning its facility is no longer committed, the funding will not be taken into consideration in the going concern assessment unless a legal waiver has been provided which resets the facility. If there is no waiver, or the waiver is in discussion, or only communicated informally, this will not suffice. We would recommend NEDs consider how companies mitigate 3 key risks: refinancing risk, liquidity risk, and financial covenant default risk. With all 3 elements, NEDs need to challenge their CFOs to ensure they have an appropriate understanding of the facilities documentation and an appreciation of whether the current debt terms remain appropriate for the business. Alongside this, they may also require a broader understanding of available debt options and be able to judge refinancing risk. So let's start with the first of those risks, refinancing. An NED needs to ask a number of questions. When does the debt mature? Does the amortization profile create potential challenges for the business? How is the company managing its relationship with its incumbent lenders? When considering refinancing facilities, the business needs to allow sufficient time to complete the process and consider the risks involved. These include a company-specific risk, debt market risk, and the audit going concern risk. Company-specific risk might include what is the relative credit strength of my business? For example, how much debt is sensible? Does my business have repeat or recurring revenues that provide solidity? Or are there factors beyond our control that might affect trading? How attractive the proposal would be for prospective lenders, and how much visibility the company has on trading performance. Debt market risk includes what lender appetite might be for my credit, and what debt options are currently available. Unlike during the global financial crisis, there are many more external financing options available to prospective borrowers. Examples of alternative funding sources that have established themselves over the last decade include direct lending funds, credit platforms, and specialist asset-based lenders. Also, how do I best mitigate against a potential market disruption event? Audit going concern risk is when the audit opinion is required and how much look forward is required. Through all these questions, the NED should be judging how much time may be required to prepare the company for a debt raise process and then to subsequently deliver it. The second risk to consider is liquidity risk. There is clearly linkage between the refinancing and the liquidity risk in understanding a company's ability to service its debt, particularly how the amortization profile of any debt that it has develops as the debt matures. You should be asking, how comfortable are you that the company has sufficient liquidity headroom in both the short and medium term to deliver its plan and manage fluctuations in trading and working capital? Are the company forecasts sufficiently detailed to make this judgment? And do they include a realistic downside scenario? And do you understand the levers available to the company to actively manage liquidity, particularly in a downside scenario? The final risk I want to talk about is financial covenant default risk. The considerations here are similar to liquidity risk, but there are further things to think about. What financial covenants is the company required to adhere to, and how much headroom is there? Are the company forecasts sufficient to make this judgment, and do you have a realistic downside scenario? Do you understand the flexibilities baked into the covenant definitions and mechanics in the loan agreement? And is the company utilising them appropriately? Do you understand the levers available to the company to manage a tightening of headroom? As an NED, if you have answers to all these potential risks, you're well on your way to understanding them and being able to deal with them.
Hi, I'm Mike Crime. I'm a partner in BDO's restructuring advisory team, and my work's about supporting businesses through periods of change and challenge. And at its core, that usually has a detailed appraisal of business plans, associated financial projections, and identification of key vulnerabilities. So given that focus, my team also contributes to the work of our audit colleagues around going concern. Now, the more unpredictable the trading conditions, the more complex the range of operating scenarios, the more complex the range of strategic responses, and the greater the potential influence of external stakeholders. So, in this environment, forecasting is not easy. There are, however, some common themes that were true pre-COVID and are equally true now when management teams prepare financial projections and challenge of those projections by executive and non-executive directors. Now, thinking about the basics, it's about the approach to forecasting. So for going concern purposes, this is all about an auditor will be looking for a client to prepare a base case forecast and some really clear schedules of underlying assumptions relating to that, and a number of relevant sensitivity scenarios that focus on identified areas of vulnerability and stress test the ability of the business to absorb underperformance in those areas without threatening viability. So the base case frames the big picture. It's the starting point for stress testing, and a key first step is understanding that bridge between recent and current performance and forecast performance. So to try and identify those areas that really matter and focus our attention there. So this is about understanding whether there are any big step changes in the business, be it sales volume, mix, margin, cost restructuring, new products, markets, whatever it might be, and their relative impact on profit and cash. So the clear understanding of the base case makes it easier to focus sensitivity scenarios in the right area. And first, we're looking to establish some reasonable downside cases that focus on those areas of perceived risk. But from there, for going concern purposes, we go one step further and we talk about the reverse stress test. So what an auditor is looking for a client to do here is to define the extent to which a business can underperform in those areas of identified business risk before going concern issues arise. So that usually manifests in two ways. One, it could be a breach of a minimum liquidity threshold. So available cash and facilities fall below the level deemed required to operate the business. Or it could be a covenant breach. So the availability of banking facilities themselves is threatened as a result of underperformance with a breach of financial covenants. And that's similar to a liquidity breach in the sense that it threatens access to the cash needed to operate the business. So these are the key points around audit of going concern. And what an auditor will be looking for is a client to identify those breaking points through the reverse stress testing and then provide comfort that those scenarios are unreasonable, or equally that if those scenarios do transpire, that there is a clear, defined suite of levers that will be pulled and mitigating measures that management can take to alleviate the risk for viability. Perhaps the biggest point, though, is timing. So a common frustration for us in restructuring advisory is that our clients sometimes wait too long to constructively engage with their challenges. And the same can be said of forecasting for going concern purposes. So all too often, forecasts can land, base case and sensitivity forecasts can land quite late in an audit process. Now, this can result in rushed or flawed projections being used for the purpose of the going concern review, which clearly is not a great position to be in. But it also restricts time available, and that restricts the time for management teams to be able to respond substantively to auditor concerns around risk areas. So that increases the risk of unwelcome going concern related commentary. So early information provision isn't just about making your auditor's life easier. These forecasts aren't prepared in the abstract. It's a key part of identifying and managing business risk. So start early is the big message. Now, in terms of pitfalls, working capital, even in benign trading environments, the modelling of working capital is where a lot of projections fall down. Even more important now in times of big shifts in activity levels. So ask questions around working capital. Do you understand the different cycles in the different parts of the business, how working capital is funded, the impact of activity levels going up or down? And don't assume that small in revenue or P&L terms will mean small in cash terms. We've seen small parts of businesses from a revenue and P&L perspective have really disproportionately impact on cash flow, cause some real issues through being heavily cash consumptive in growth. So this again is particularly relevant with businesses recovering from lower COVID activity levels. And have there been any dealings during the COVID disruption that give rise to unusual circumstances? So we've seen this with intra-group financing. If parts of an international group are reliant on other parts of the group in other jurisdictions for funding, then is there anything in local government support schemes that have been received that might restrict those cash flows? We've seen that in some projects involving US and German support schemes. Like for like, so rarely have comparables been less comparable. Companies may have benefited from margin enhancing measures, like VAT rate changes for hospitality businesses. They may have benefited from temporary cost reductions, furlough, rent rate concessions, things like that. A current project I'm working on is seeing a forecast with some really significant reductions in forecast travel and entertainment expenditure on the assumption of a new normal with vastly reduced client contact from a sales perspective. So, challenge those areas where COVID has benefited a business as well as harmed a business, and really test whether those benefits are expected to be permanent or are temporary and should be laid back in terms of costs. Really focus on third-party risks. So what measures are in place to engage with business critical suppliers, largest customers, to better understand and manage risk. And at a time where lots of business are seeking to squeeze their supply chain, do you really understand the financial position of those you're relying on? Even if you're treating them fairly, maybe not everybody is. We've supported clients assess supply chains, develop contingency plans for supply chain failure, but be mindful that works both ways. So are you a sole business critical supplier to a large customer? And is there a risk that your own business may be diluted through your customers looking to diversify supply chains? Availability of third-party capital. What's changed? Might anything change regarding access to capital? So, lots to consider, but if I could leave with one message, it would be to engage with the going concern audit process as early as possible. If it may be a thorny area of the audit, please don't let it be because time ran short. But I wish you all the very best for your next audit and beyond, and thanks for listening. Thank you.